Welcome to our masterclass on the cash flow statement, a truly indispensable tool for understanding the genuine financial health of any business. While a company's profit and loss statement, or income statement, reveals its profitability over a period, it doesn't always tell the full story about the actual cash flowing in and out. This is precisely where the cash flow statement becomes critical. It provides a crystal clear, comprehensive overview of all cash inflows and outflows, dissecting them to reveal a company's operational health, immediate liquidity, and long-term solvency, far beyond what net income alone can communicate. It's the ultimate reality check, showing where cash truly comes from and where it goes, empowering you to assess whether a business is truly generating the cash it needs to thrive and grow. The cash flow statement neatly categorizes all cash movements into three fundamental activities, each offering a distinct perspective on a company's financial dynamics. Understanding these three core sections is absolutely essential for anyone looking to truly decipher a business's cash flow narrative. First, we have operating activities, which reveal the cash generated from a company's primary day-to-day business operations. Second, investing activities detail the cash flows associated with the purchase or sale of long-term assets, crucial for understanding a company's strategic growth and capital expenditure. Finally, financing activities showcase cash related to transactions with a company's owners and creditors, such as debt and equity movements. Each pillar contributes uniquely to the overall cash picture, painting a holistic view of financial performance. Let's dive deeper into cash flow from operating activities, often abbreviated as CFO. This section is arguably the most vital indicator of a company's ability to generate cash from its core, day-to-day business functions. It tracks the cash generated from selling products or services, as well as the cash paid out for operational expenses, like supplier payments, employee salaries, and overhead. Crucially, it also accounts for the impact of working capital changes, such as increases or decreases in accounts receivable, inventory, and accounts payable. A consistently positive and growing CFO signifies a healthy, sustainable business model that can fund its operations without relying on external financing, making it a powerful testament to a company's inherent profitability and efficiency in its primary revenue-generating activities. Next, we explore cash flow from investing activities, or CFI. This section provides critical insights into how a company is allocating its capital for long-term growth and strategic expansion. It meticulously details cash flows resulting from the purchase or sale of long-term assets, which are typically assets expected to provide benefits for more than 1 year. This includes significant expenditures on property, plant, and equipment, often referred to as capital expenditures, or CapEx, which are crucial for maintaining and expanding operational capacity. Furthermore, it encompasses transactions related to buying or selling other companies, investments in marketable securities, and even intellectual property. Analyzing CFI helps investors and business owners understand whether a company is strategically reinvesting in itself for future development or liquidating assets, thereby revealing its long-term vision and growth trajectory. Finally, we turn our attention to cash flow from financing activities, or CFF. This segment eliminates how a company raises and repays capital, effectively detailing its interactions with both its owners and creditors. It encompasses crucial transactions such as the issuance of new debt or the repayment of existing loans, which directly impacts the company's leverage and financial risk. Additionally, it tracks equity transactions, including the issuance of new shares, share buybacks, and most importantly, the payment of dividends to shareholders. The CFF section offers a clear window into a company's capital structure decisions, indicating whether it's expanding its debt, diluting ownership, or returning value to investors. A careful examination of CFF is vital for understanding a company's financial policy, its approach to managing its capital base, and its commitment to shareholder returns. When it comes to preparing the cash flow statement, particularly the operating activities section, two primary methods are recognized: the direct method and the indirect method. Both methods ultimately arrive at the same net cash flow from operating activities, but they present the information in different formats. The direct method is often considered more intuitive, as it directly lists the actual cash receipts and cash payments for operating activities, such as cash received from customers and cash paid to suppliers. In contrast, the indirect method, which is far more commonly used, starts with net income from the income statement and then adjusts it for non-cash items, non-operating items, and changes in working capital accounts to arrive at the operating cash flow. Both methods are crucial for compliance with global accounting standards like GAAP and IFRS, ensuring consistency and transparency in financial reporting. Moving beyond the basics, let's explore free cash flow, or FCF, often regarded as one of the most powerful metrics for valuing a company and assessing its true financial health. FCF represents the cash a company generates after accounting for cash operating expenses and capital expenditures such as purchasing property, plant, and equipment. In essence, it's the cash left over that the company can freely use to pay down debt, issue dividends, buy back shares, or invest in new growth opportunities. It's distinctly different from net income, which can be influenced by non-cash accounting entries, and EBITDA, which excludes capital expenditures. FCF provides a much clearer picture of a company's ability to generate cash that is truly free for discretionary uses, making it an invaluable indicator for investors and stakeholders assessing long-term sustainability and potential for value creation. One of the most crucial aspects of mastering the cash flow statement is understanding the impact of non-cash items. While the income statement focuses on accrual accounting, recognizing revenues and expenses when incurred, the cash flow statement hones in on actual cash movements. This distinction is particularly important when considering items like depreciation and amortization. Depreciation, for instance, systematically allocates the cost of a tangible asset over its useful life, reducing net income on paper, but it doesn't involve an actual cash outflow in the current period. Similarly, amortization applies to intangible assets. These non-cash expenses, while reducing reported profit, do not deplete a company's actual cash reserves. Recognizing this difference is key to understanding why a profitable company might have low cash flow or vice versa, providing a more accurate assessment of its financial liquidity and operational efficiency. The power of the cash flow statement extends far beyond mere compliance. It's a strategic compass that empowers truly informed decision-making. By thoroughly analyzing cash flow from operations, investing, and financing, you gain invaluable insights. You can accurately assess a business's capacity for sustainable growth, identifying whether it genuinely generates enough internal cash to fund its expansion plans without over-relying on external debt or equity. Crucially, it helps identify potential liquidity issues before they become crises by revealing cash shortfalls despite reported profits. This understanding is invaluable for small business owners managing daily operations, investors evaluating potential opportunities, and finance students building a foundational understanding. The cash flow statement provides a clearer, unvarnished picture of a company's financial pulse, enabling proactive and strategic choices. Congratulations! You've just gained a deeper understanding of the cash flow statement, a truly essential financial document for anyone serious about business and finance. By dissecting cash movements into operating, investing, and financing activities, you now possess the knowledge to uncover a business's true health and profitability, moving beyond the often misleading picture presented by net income alone. This masterclass has equipped you with the ability to identify a company's sustainable growth potential, spot liquidity risks, and make more informed strategic decisions. Whether you're a small business owner, an astute investor, or an aspiring finance professional, we encourage you to apply these powerful insights to your own financial analysis. To continue enhancing your financial acumen and gain further expert commentary and actionable insights, make sure to